Nifty is down about 82 points, so not a good opening at all.
Compared to our neighborhood, this is not a bad picture at all, though it's a red screen.
Seen a swift recovery from the lows, but the Nifty still is in the red.
Almost ditto repeat of Monday, a 100-point cut early on in the session, and then bulk of the day spent recovering. Well, a 10-point change higher, but it's a giant recovery day today from the day's low. I think the Nifty Bank had a bit of a weaker recovery, so as to speak.
Hello and welcome to Markets Today, the show where we track about 6 hours of the day's trading action in 5 headlines. I'm Ekta Batra. Here are the top stories for this evening. Stock markets recover in late trade. The sensex gains nearly 150 points. The Nifty gains over 30 points. IT stocks lift the markets even as bank stocks drag. More than 8% equity in Adani Power changes hands. Sources say the promoter entity is the likely seller through a block deal for nearly 9,000 crores. IndiGo co-founder Rakesh Gangwal and family sells around 5% stake in the airline. Sources say it's the third tranche of sale, bringing Gangwal's holding below 26%. Infosys inks a $1.6 billion deal with Liberty Global to expand the entertainment and connectivity platforms of the digital communications firm. The deal value could go up to $2.5 billion if the tenure is extended from 5 to 8 years. M&M unveils its new electric brand identity, showcases 2 EVs, a pickup and its lightweight tractor Oja at Cape Town. The new tractors are seen driving future growth of the farm equipment business. Hindustan Copper falls 6%. Q1 margin contracts to 25% from 41% in the last quarter. Stock also comes out of the F&O ban. SBFC Finance makes a stellar debut on the exchanges, lists at over 40% premium to the issue price. Glenmark Pharma is under pressure despite a decent first quarter performance. All right, first up, the day's trading action. The Wall Street staged a late recovery. The Nifty reclaimed the 19,450 mark, while the Sensex rose 138 points. Both the indices ended mildly in the green. No respite for the banking stocks as they continue to languish. Nifty Bank ended 0.25% lower. Nifty IT batted for the bulls, with that index gaining over 0.5%. Prashant is here with a market wrap.
Well, almost an exact replica in terms of price action, what we saw the last trading session, which was Monday. That was today's day. We got a cut early on and then spent the rest of the day basically slowly but steadily recovering. The intraday tells you that story. So it was actually a pretty good session. You had the Bank Nifty, where we once again, like the last session, which was Monday, saw a weaker recovery. The index there ending about 1/3% lower. No help from banks really. Mid caps and small caps, well, doing very well. And small caps really, not just even mid caps. Small caps is where the bulk of the action has been, and people have been willing to go down the market cap curve about 0.6% on the small cap index. Nifty gainers, before I quickly get to those small caps, Ultratech, Apollo Hospitals, NTPC were the gainers that we had, which were some of the top ones. Now the broader markets, right? This is where the action picks up. Defense companies, Cochin Shipyard, Garden Reach, Paras Defense, doing very well. Old economy names, JSW Energy, Dredging Corporation, up on your screen. These milk companies, Parag Milk, Dodla Dairy, financials like Indian Overseas Bank, Central Bank, Religare, Arman Financial, jewelry companies, not the titans of the world, but Kalyan Jewelry, a name like Tribhuvan Das Zaveri, back at a triple-digit values now. JBM Auto, Electra, that news about electric buses coming in from Delhi. HPL Power, Texmo Pipes, Schneider. I can go down the list. VIP Industries, there was news flow there. Idea Forge recovered after having a pretty bad last few weeks now. And IIFL Securities was another one which did quite well. There were some cuts as well. I mean, Crompton, HOEC, Indus Tower, BSC lost a little bit. Dreamfolk's numbers have been pretty poor. Sirma, Kirloskar Brothers, some pulling back after what have been steep runs. But by and large, the momentum is intact in the smaller part of the market. Well, we watch US markets once again, where the problem is that it's so good that it's actually bad. Economy there is looking good, which means that the dollar is rising. I think the dollar and oil are the two things we need to watch as we come back again tomorrow morning. Back to you.
Okay, all right, Prashant. Thanks very much for that. Well, in market opinion, Kenneth Andrande, who's the founder and chief executive officer at Old Bridge Capital Management, said that markets have reacted to good news in the corporate world, but he added that markets face the risk of valuation, mainly on the basis of future growth. He also lays out his outlook on autos.
So, I think markets just reacted to all the good news that's there in the corporate world, right? And if you go back to the quarterly numbers and as they roll out, there are hardly any disappointments that are there in the entire in this quarter numbers, or even if I step back to last year's numbers. So markets effectively reacting to all of that. Now, all said and done, it's been a great 2023 so far, and the undervaluation that, or some part of the undervaluation that was there in the last year, has evened itself out, and some part of the market continues to remain reasonably expensive. Now, the only risk that the market faces is in valuations, and when we talk about valuations, also this is also on context on future growth. Now, it's a size of the market that can only grow. You've come to a level where the market is we're almost at a maturity stage in the market, whether it's two-wheelers or whether it is four-wheelers, and you've got a shift in technology. I definitely prefer the vehicle manufacturers to the automotive ancillaries out there, but we'll have to just wait till at least from our perspective, we just have to wait till things get a little better as far as entry levels are concerned.
All right, let's move on to the second headline for today. More than 8% shareholding in Adani Power changed hands today. Sources say Adani promoters are the likely sellers through block deals worth 9,000 crores. Nimesh Shah is here with the details. Nimesh, what do we know about this deal?
Well, there's a large block in Adani Power today. Nearly 8% of the company's equity got changed hands at an average price of 280 rupees per share. Now, in terms of seller, I understand the promoter entity was a seller in today's block, and in terms of a buyer, a single large global marquee fund was a buyer in today's block deal. Now, the 8% equity at the current price is valued close to $1 billion, and the promoter holding is close to 75%. But after today's stake sale of 8%, that will fall down to nearly 68%. So, in a large block in Adani Power, nearly 8% equity got changed hands, and a single marquee global investor was a buyer, and they've invested close to $1 billion in Adani Power today via block deal.
Thanks, Nimesh, for that. Well, moving on, shares of IndiGo Aviation saw a sharp fall in trade today after the company reported a block deal worth more than 4,800 crores. This amount equates to 5.1% of equity in the company, and sources say this is the third tranche of selling done by the Gangwal family. Sonia is here with the details.
There was a large trade that took place this morning where 2 crore shares, which is 5.1% equity, changed hands at a price of 2,430 rupees, and this was worth almost 5,000 crores, so a fairly large deal taking place. There was a very strong response coming in from global as well as domestic funds. So it is likely that the Gangwal family has sold part of their stake, and that has been received by a lot of global as well as domestic funds. Now, the Gangwal family, this is the third tranche of selling. And, after the selling that they've seen earlier, they had about 29.7% stake. And post-selling of this stake, they would be somewhere to the tune of around 25.7%, which is still almost 25,250 crores worth of stake that the Gangwal family has. So there is a bit of an overhang that perhaps, there could be more promoter stake selling. And that could be the reason why the stock is under pressure. But the larger story here is the zooming business of IndiGo. IndiGo has about 80% market share in some of the monopolistic routes. It is the market leader in the space right now. The stock has surged almost 40% in the last 6 months. The earnings have been very, very strong. In fact, in the quarter gone by, it's been record high EBITDA and revenue for the company. And there are still many tailwinds, whether it's strong domestic traffic, whether it's, higher yields, lower crude prices. And there are many bulls on the street as well. So Citi, for example, raised their target price to 3,400 rupees, which is a big upside to the current market price, while Macquarie has outperformed with a target price of 2,950. Back to you.
Okay, all right, Sonia, thanks very much for that. Well, on to a CNBC-TV18 exclusive then. Religare soared 6% after we learned from sources that the Berman family has increased its stake in the company via block deal. Remember, the Berman family held 14% stake in Religare as of June. Religare Enterprises is a subsidiary of Religare Finvest, which aims to raise around 800 crores through a QIP or a qualified institutional placement. Well, moving on to the third headline this evening, Infosys gained close to 2%. The tech giant has signed a 5-year agreement worth $1.6 billion from Liberty Global. This to evolve and scale the communication firm's digital entertainment and connectivity platforms. Reema's here with the details and the key contours.
Thanks so much for that. So as you pointed out, Infosys has won a mega deal. It's a 1.5 billion euro deal from the Liberty Group, a telecom company, to be executed in the next 5 years. If the deal gets extended to 8 years, then the deal is estimated to be 2.3 billion euro. So this is a very large deal. There are two questions, though, as JP Morgan also highlights. One, is it going to be margin dilutive? According to JP Morgan, it could be. And secondly, because Liberty Group is an existing client of Infosys, the question is how much of it is going to be incremental revenue, the net new revenue. According to JP Morgan, this deal is unlikely to be a significant contributor in FY24, but it could add 70 to 90 basis points to next year's growth, FY25. The good part is mega deals appear to be coming back. So last week it was HCL Tech, which won an over $2 billion deal from Verizon, and now it's this Infosys Liberty Group deal.
Okay, all right, Reema, thanks very much for that. Well, on to another key development. SEBI has proposed sweeping changes to the voluntary delisting process. A new consultation paper proposed alternatives to the reverse book building process and reducing the threshold for the counter offer. Market regulator has called for public comments till the 4th of September. Yash Jain is here with the key highlights.
Well, as SEBI chairperson in the last board meeting said that SEBI does not like any Abhimanyus in the market, and that's the context in which this particular proposal has come. Some very crucial changes to the current voluntary delisting regulation. SEBI has sought stakeholder comments on these proposed changes by September 4th. The main focus for these changes have been 4 different segments of delisting process. First one on alternatives to the reverse book building process, then counter offer framework, the third one determination of floor price, and finally the last one on the review of reference date for the determination of floor price for the delisting. Let's get to the first and the most important one. SEBI has proposed an alternative mechanism to the reverse book building process, which is the only delisting mechanism which currently exists. This alternate mechanism would be delisting through a fixed price arrived as per the delisting regulations. What does this do? It reduces volatility, brings certainty on the delisting prices, and also helps the acquirer to arrange funds for the delisting process. The second one is on the reduced threshold for the counter offer for delisting after the first offer fails. Now, if the acquirer cannot acquire 90% of the shares in the company, then the delisting fails. The proposal is to reduce the threshold from 90% for the counter delisting offer. The third change is on the eligibility criteria for coming out with a counter delisting offer in case the first one fails. SEBI says that a company can only bring out a counter offer if the bids received in the first offer is higher than 2 points. First one is the higher of difference between the acquirer shareholding and 75%, and the second one is higher of 50% of the public shareholding. Currently, a counter offer for delisting can be brought irrespective of the bids that have been received in the first delisting attempt. Now, the next one, SEBI has proposed to consider date of board meeting for approving delisting as the reference date for determination of floor price instead of the current rule where the day of intimation to the stock exchanges on the board meeting is considered as the reference date. SEBI also proposed to bring out separate delisting regulations for investment holding companies under which transfer of shares in listed companies held by the IHC will be done to public shareholders. Also, cash payments to public shareholders of the IHC will be done against the investments in unlisted companies. This is to ensure that the delisting price for the investment holding company reflects its right intrinsic value.
Okay, all right, Yash, thanks very much for that. Time for a break now. But up next, we'll be back in a quick bit with all of the other top stories. Welcome back to Markets Today on CNBC-TV18. Well, on to the fourth headline for this evening. Mahindra & Mahindra rallied over 1.5% after unveiling its new electric brand identity. The auto major's farm and auto division has launched the Oja range of tractors in Cape Town. Parikshit Luthra joins in with the details on this.
Here in Cape Town, the Mahindra Group has outlined its future strategy for electric vehicles and the farm equipment sector. Starting with electric vehicles. Now, this is a time when electric car sales are picking up and they could cross the 1 lakh mark. Mahindra has only one electric SUV in the market right now. Next year will be the E8, which will hit the markets in December 2024. What they have done, they have unveiled a new brand identity for electric vehicles, an infinity loop logo, which will be carried by all future electric vehicles, including born electric and ICE vehicles, which are converted into electric in future. This is to differentiate the EV portfolio from the ICE portfolio, which will continue to carry the Twin Peaks logo. They've also showcased a production-ready BE05 electric SUV to show that they are ready with an electric SUV for the market. Behind me is an electric Thar, a 5-door electric Thar, which could come to markets after 2027. This is also an indicator of the 5-door ICE version of the Thar, which will hit the markets next fiscal. The company has also showcased the Oja range of tractors. Now, these are ICE tractors exclusively in the farm segment. And this will be important for the Mahindra Group because these are lightweight tractors that have been launched to target farmers in the horticulture sector, orchard farming, those with smaller land parcels, not just in India, but in ASEAN and US. And the company believes that this will be important for driving their market share, driving the next phase of growth in the tractor segment.
Okay, all right, Parikshit. Thanks very much for that. Well, moving on to the fifth story today, Hindustan Copper tumbled over 6% after the company posted a weak set of first quarter numbers. The company's revenue came in single digits, while a rise in expenses led to an impact on its net profit and operational performance. Nigel D'Souza is here with the details.
Well, let's give you 5 top reasons why Hindustan Copper, it was under pressure. A couple of reasons. One is it just hit its 52-week high, so the stock has seen a big rally in anticipation of these numbers. That's point number one. So the scope of disappointment was very limited. Point number two is it came out of the F&O band. Remember, so that's some sort of position that we've seen in the F&O market. Normally, you see some stocks, they react rather in a big way. So that's 2 points with regard to the trading action. The third point is on the margins. The margins on a year-on-year basis as well as on a sequential basis, well, they're sharply lower, coming at mid-20s. On both the same quarter last year it was more than 30%, previous quarter it was more than 40%. Now, one factor that's played out besides weaker core prices is that other expenditure has spiked up. It spiked up by close to around 48%. So we'll require further clarity as to why that happened. That's the reason why, in fact, the margins have got compressed. Weaker copper prices, and the second factor is higher other expenditure. Next up on the valuation parameter. Remember, there's plenty of scope that the use of copper could be very, very large in the times to come. But as of now, if you look at it on a trading basis, they did an EPS of only around 3 rupees in the past year. So in that context, it's trading at around 45 times. We'll have to see a substantial improvement on earnings from year on to justify these prices on the stock. And finally, it's a tighter held company. You have the promoter entity, which is the government of India, that has more than 66% stake. And institutions out there, they have nearly around 18% stake in the company. So put all these factors together, Hindustan Copper under pressure. Back to you.
Okay, all right, Nigel. Thanks very much for that. Well, moving on. SBFC Finance surged a whopping 62% after the finance company made a healthy debut on the Lal Street. The stock listed at 82 rupees per share versus an issue price of 57 rupees. Abhishek Kothari is here with the details.
Strong listing for SBFC Finance. The valuation post the fundraise, if you take into account FY23 book value, is now at around 3.9 times price to book value, listing gain of around 59% versus IPO valuation of about 2.4 times price to book value. So the subscription was strong at about 74 times or even more. SWOT analysis, that is strength, weakness and opportunity and threats. In that, the strength is the management. Asim Dhru, investors have betted big on his visions, is the feedback that I've got. Focus is on a secured book with adequate seasoning and lower loan to value in the SME portfolio especially. So low leverage despite scaling up the book, which offers a good ROE potential going forward, and healthy capitalization level as well. They primarily focused on low and middle income small business customers, but on the secured side and not on unsecured side. Weakness, the return on equity is on the lower side, moderate asset quality, and write-offs have aided the asset quality quality last time around. Opportunity, there is huge opportunity for growth over here. Improvisation in earning profile can be expected going forward. Average LTV, that is loan to value in MSME, is just 42.5%, which offers a good secured portfolio over there and healthy coverage as well. Market potential is huge, and the rise in SME portion of the book also shows that risk have come off drastically. So if you take into account risk weight to assets, to AUM ratio, that's declined massively from 150-160% to right now about 111%. The threat is the ability to manage the asset quality while you are scaling up the business. Micro enterprise segment concentration, the concentration is huge on a single segment. Cost of funds can hurt margins in FY24. We are in a rising, interest rate scenario, and moratorium of the book at around 6% looks to be tad bit on the higher side. Any slippage into NPA can hurt the provisions as well. Geographic concentration, 70% of AUM is in 6 states, and MSME book, as I mentioned earlier, about 79% offers a concentration risk as well. Back to you.
Okay, all right, Abhishek. Thanks very much for that. So strong listing there. But moving on, Glenmark Pharma slipped even after reporting what was a decent set of first quarter numbers. The company has also held on to its guidance. So, for example, they did revenue growth of around 22% in Q1. They're holding on to their revenue guidance of around 10 to 11% for FY24 and holding on to a margin guidance of 19 to 20 odd %, something that they had detailed in the previous quarter. Now, in terms of the debt figures, the gross debt stands at around 4,400 crores. The company has indicated that they are focusing on decent cash generation. The target is to be net debt free by FY26. Now, coming to the US business, they did around $98 million in terms of US sales versus estimates of $100 to $102 million. They are tracking $100 million in terms of sales every quarter in the US. India, adjusted for one-offs such as NLEM impact as well as divestment of brands, was up around 8 odd %. The respiratory portfolio of the company has been doing very well. One of their key products is Ryaltris within the respiratory portfolio, which they have launched across multiple markets. They have said that they could probably exceed that $40 to $45 million target that they had set out for the fiscal in terms of revenue from Ryaltris. They did around $10 to $15 million already in terms of sales in Q1. Lastly, one of the key triggers going forward would be selling 7 to 8% stake in Glenmark Life Sciences, which is the API arm. They have to reduce their shareholding to 75% as per the norm, as per the law, and hence there is this block or large trade or eventual letting go of 7 to 8% that we can expect from Glenmark in Glenmark Life Sciences. On that note, let's listen in to the management.
So we had given a guidance that during our last investor conference that by 26 we should be net debt, positive. Negative. So I think our overall revenues we are seeing about $100 million in terms of the US $1 million per quarter. So I think that's good traction, and we see a single-digit growth in the US.
All right, and with that, it's a wrap on this edition of Markets Today. Thanks very much for watching.